Welcome to this month's Spotlight. This month we're discussing with a few key individuals the total expense ratio. The TER has been a hot topic over the past few years because clients are finding out that they're paying a little bit more than they actually thought they were. This month we're interviewing a few key commentators to delve into the TER and what it means for their clients.
I'm not at all convinced that the public are generally aware that there are charges within collective investment schemes. Maybe they ought to be, but I suspect that by and large the public look on any sort of investment product as what am I likely to get out of it net, rather than grossing up return versus minuses.
I don't think that the general public is necessarily made that aware of what the other costs associated with the investments that they're making are.
It's the reverse of the miracle of compound interest. This story I tell, this going off at a slight tangent here, is if somebody makes full contributions into a pension scheme for their child from birth to age 18, compound interest will take that up to the lifetime limit. The reverse applies in this case. A 0.5% reduction in yield doesn't sound very much, but over the course of 20 years, it can be a scary amount of money.
Costs are important in that their compound effect has a very damaging effect on the gross return that an investor can expect to get out of their fund.
There's often a trade-off between simplicity and accuracy with these things. I think, bless them, the FSA have gone for simplicity, which means that they are, unfortunately, inaccurate in the total cost that an investment is actually suffering. And one thing we're always concerned about with our clients when we're advising them on these matters is to look at what I always call churn, the amount of dealing that's going on within a portfolio, which generates a lot of cost. And there's obviously a difference between a fairly passive fund, let's say an index fund, which is just tracking a particular index and has a very limited number of transactions, and those sort of discretionary managers who, let's be honest, can generate a great deal of profit for their organisation by just churning a portfolio between stocks.
I believe that costs are so important to an investor's experience because of the depleting effect that they have on the compound return that the investor receives. Simply, the higher the costs an investor is incurring during the course of his investment, the lower the compound annual rate of return, other things being equal, and therefore the lower his median terminal wealth will be.
I actually had a meeting on Friday with probably one of my more, let's say, numerically sophisticated clients. He's in software, is an engineer by training, and so understands these things. And he was unaware of the impact of this. The day before, he'd gone to see, let's call it, a major high street institution whose charges were in excess of 1.5% for a tracker fund. Indeed. And he had an inkling that this was a little high, but no real idea of just how high and the impact it would have on his fund, which was not an insignificant amount of money. It's because the customer doesn't realise they're paying. And where the customer doesn't realise they're paying, frankly, you get a market failure because there's no pressure to reduce the costs. I'm surprised how even sophisticated people don't like to think about their finances very often. Maybe once a year when they come and see me.
The FSA's definition of total expenses is intended to provide a measure of comparability as between different investment managers or investment vehicles. What it certainly does not do, in my view, is provide a measure of total expenses.
And the accountants as a body tend to shy away from this area, partly because not all of us are particularly exposed to the area. We tend to be a fairly defensive profession as well. We'd rather not lose our clients' money than perhaps maximise it. Now, every accountant's inclination is to have transparency and to know what's going on, what costs are going through, what is the impact of that, are they reasonable in the context of the wider market. Now, if somebody's paying, 3% for management and somebody else is charging 1%, well, why are the first mob charging 3 times as much? Is the fund getting 3 times the service? Probably not.
Personally, I don't think fund managers have anything to be particularly concerned about in the costs that they charge. The labourer is worthy of his hire. The ones who have something to be concerned about are the ones who are charging high fees and delivering very poor returns.
I can't see why something that is purportedly the total expenses doesn't include all the expenses.
It is sometimes particularly difficult to get fund managers and brokers to understand that it's the after-tax return that's important to the investor, not the pre-tax return.
The whole point of the TER is to have a certain amount of comparability. If you believe that yours is different, well, you can explain that alongside your numbers, and then people can decide for themselves. But again, as I say, if somebody's charging 3 times as much as the person next door, I want to be in a position to go in and ask why. If I don't have all of those figures, it's very hard for me to ask why.
In the case of a fund which has a total expense ratio of, say, 1.8%, precisely because that total expense ratio is not capturing, for example, the cost of transaction and dealing, the total cost of operations of that fund would clearly be in excess of the 1.8%. Now, how much in excess is, if we're looking specifically at transactions costs, how much in excess of the 1.8% would be entirely dependent upon how much turnover the fund does, where the fund is active, and whether he's paying full or discounted commissions. But that could easily add another 1 or 2% to on top of the TER.
If you walk into sort of any other professional in the land, be it an architect, a lawyer, an accountant, or whatever, when you pay your money, you've got a pretty clear idea of what the output is going to be. Unfortunately, with fund management, it's a lot less clear. Again, I'm probably not the best person to say what the answer to that is, but with some funds, you will get an explicit services bolted on, and that's a nice thing to have, and that justifies additional costs.
The compounding effect of costs is something that does need to be taken into account. If somebody is trying to encourage an investor into a fund on the basis of the gross returns pre-costs, then that is misleading, to say the least. And in that sense, the investor should be worried about the compounding effect of costs.
I'm a great believer in making prices clear. You know, if I go out and buy a car, I want to know that it costs £30,000. I don't want to have costs crawling out of the woodwork over the next year, which I didn't know anything about.